Welcome to the 7th episode of the Sydney Contrarian, titled Debunking Popular Myths 1. Understanding prices and returns and why buying when prices are falling may be a good idea in some cases. This episode focuses more on providing an alternative perspective into investing by offering you insights into how you can better manage your investment portfolio. I'm going to talk about some common misconceptions of investment as peddled by the mainstream media and some investment advisors who want you to put your cash with them so they can earn their commissions and fees. In particular, I will talk about why it matters to look at the stock price returns and not how high or low stock prices are when one invests. I'll also compare the merits and limitations of the buy and hold strategy against the strategy of making consistent contributions. Finally, I'll also show how investors should not be letting falling prices of good quality companies turn them off from investing, because sometimes this may lead to very rewarding outcomes if you stick by your guns. To illustrate my point, I'll use real companies and real prices. I hope that you'll find it easy to understand. But allow me at this point to state that this video uses two stocks as examples, and they have been purposely selected to make a point. They are not representative of all stocks in the market, and much time is needed to understand the underlying operational and financial potential of these companies before you make a decision on investing in them. And to understand the operational and financial potential of these companies also require in-depth understanding of the economy, of financial statement analysis, and how to read an annual report. I'll cover some of these in future episodes. You should take the message from these examples as a lesson rather than consider this episode as a recommendation to invest in any of the companies or even the market at all. Also, what I say in this video should not be taken as professional financial advice. You need to do your own research and consult a professional before making financial decisions. A common myth in investing is to buy stocks when they're rising and avoiding them or selling them when they are falling. The reason behind this is because when you're buying stocks, you want to sell them at a higher price, and watch prices fall is going to go against your objective. However, the question comes down to whether you're investing once and leaving it there, which is called a buy and hold strategy, or you're going to do something else. Investors who buy and hold are more likely to face losses and also miss out on substantial profits compared to those who invest on a consistent basis on companies that may dip in price but recover over time. There's a reason for this, because if you are using the buy and hold strategy, you are going to be more likely to be affected by the ups and downs of the market, because a buy and hold strategy where you're buying once and holding it, there is less margin for error. In your mind, you want to get it right, and you want to get it right at that time. And you already feel you have one try. But if you're buying consistently into the market and selling consistently out of the market, you might provide yourself a little more room for error. And you're not going to chase the final cent in either buying or selling. In this example, I have provided two hypothetical cases to illustrate my point. The first case involves a company where the stock price falls from $10 to $6 in the first 4 periods, and then recovers by $2 each period for a couple of periods, and then finally it rises by $4 so that it ends up being double the initial price at $20. The second case involves a company where the stock price is consistently increasing by $1 from $10 to $20 over the 10 periods. To an investor who adopts the buy and hold strategy, naturally they'll prefer case 2, since they will see their investment gradually increase. Case 1 would leave them quite upset for some period of time as their investment is decreasing. They may not even be able to remain in the market because as they see the stock price fall, they might sell into the market and miss out on the recovery. So if you consider the strategy of making consistent $1,000 periodic contribution, you'll actually find that case 1 which is the case where the prices fall and then recover, does lead to a substantially better outcome than case 2. Even though the stock price fell 40% at one stage, it recovered so that at the end of the 10 periods the stock price has doubled, and some of those purchases as the price falls, you are actually earning much higher returns. So at the end of the term for case 1, your $11,000 of contribution has accumulated to $22,758. That's more than double what you put in. Compared to case 2, where the stock price doubled over the period without falling, your $11,000 investment only accumulates to $15,375. So case 1 delivers almost 50% more than case 2. Now, Warren Buffett once talked in a recent annual shareholders meeting that one should be buying when the market is falling, since when that happens, you can actually buy more for the same amount you put in. That is true. What he's talking about, though, is just the tip of the iceberg. Buffett buys only companies that he recognizes have financial and operational strengths. Companies that are generating income and have good quality management. He's also talking not about buy and hold investment strategy, but a strategy whereby you are regularly investing in the market on what are undervalued stocks. The second common investment myth is that one considers whether a stock is expensive or not based on the absolute price level. So a stock trading at $25 may be considered expensive, while a stock trading at 5 cents may be considered cheap. This misconception is common, and is partly right at best, but at worst could lead to you making really bad investment decisions as you focus on stocks that are cheap, but they may actually provide you with no fundamental potential. In other words, these companies could well be trading at such low prices because they generate no revenue or profits for which to justify whether you should pay to buy these companies. What actually matters is the changes in stock price or the stock price returns. How much is a relative change in the stock price compared to what you pay for it? Let's have a look at two real-life examples. Commonwealth Bank of Australia and Resolute Mining Limited. Two very different companies. I know that some will criticize me using these two companies to illustrate my point, but let's explore this anyway, because the point of it is not about comparing these two companies, but it is to illustrate my point about price and returns. The aim is to show you that what matters is not the stock price level, but the returns it delivers based on the change in the stock price over time. Higher stock price means that stock prices can change more on a daily basis, but the returns delivered could be less on a relative basis. If you look at the figure at the top, you can see the stock prices of CBA and RSG using two different axes. The price levels are very different, and you can actually compare them by looking at the right axes. You can see that CBA stock prices are more stable and in an increasing pattern over the 8-year period, at least predominantly so. While RSG, the price has actually gone up and down, and investors who have gone for quite a wild ride, and perhaps some investors may have had heart attacks, or 2 or 3. The figure at the bottom shows what actually matters to investors, but it's not always evident if you read mainstream media news or rely on broker websites, because what they focus on are just prices. They occasionally talk about the percentage changes, but you seem to be showing graphs of how the prices have gone up and down. The daily returns that I have shown you in that figure calculate the relative price changes on a daily basis. And yes, CBA stocks are generally much less volatile than RSG stocks. On some days, and not an insignificant number of them, RSG stocks were rising or falling more than 10%, while CBA stocks only experienced 1 or 2 days in early 2009, and that was it. Now you may go so far to conclude that stocks with higher price levels are likely to be more stable than stocks with lower price levels, because from this example we see that CBA stock prices are indeed higher than RSG, and they have been more stable based on relative price changes on a daily basis. However, bear with me as later on I'll show you how the stock price returns on RSG would actually lead to investors making a much better return to this date of recording if one uses the right strategy and the right perspective of investing. Also, I can easily find cases of the reverse anyway, where a stock with higher price levels is less stable than a stock with a lower price level. So what actually matters is not the stock price, but the company itself and the industry, the geographic location that they operate in, among many factors. That I will not cover in this episode, but do keep it in mind. So let us have a look at the buy and hold investment strategy and how it performs for these two stocks. There are some interesting observations to note other than the obvious point on which stock performs better under such a strategy. Let me start with the less obvious point. You may be aware that some stocks pay dividends to their shareholders. These dividends often come out of the company's profits after considering the amount that they wish to keep in order to expand the business. Investors receive these dividends, and these count as return. At the same time, investors may reinvest these dividends back in the company or spend it or save it elsewhere. The stock price will actually fall by approximately the dividends paid for obvious reasons that the company value is adjusted by what is paid out to the shareholder. We also ignore tax effects in this case. So if a company pays dividends regularly, like that of CBA, the actual returns as earned by the shareholders should be more than the stock price appreciation during the period, because it adds to the additional return. So while investors who invest $100 into CBA stocks at the start of 2009 will have their holdings increased to $294.91 by March 2017, their actual investment would have been worth $472.73 when we include dividends that are paid and we assume that they're immediately reinvested into the company. The implied change in stock price over this period would have been from $28.74 to just over $134. Now CBA stocks are trading at $84.77 when the analysis was being done. That equates to an additional $50 or so, resulting in additional dividends that are paid and then reinvested into the company. Buy and hold investors would perform better with CBA stocks than RSG stocks, as we can see. RSG does not pay much dividends. You can see that $100 invested in the beginning of 2009 would have been worth $305.08 at the end of the same period. And if you include dividends, the total investment would be worth $323.13, a very modest difference. It is worth noting that during the period from late 2014 to early 2016, one's investment would have been less than $100. The ride was rough, and many would have been very discouraged as they saw the investment reach almost $450 in 2012, and then collapse in less than 2 years to less than what they initially put in. So if you are an investor who likes to put your cash into stocks but not have to care about it much, you may want stocks to rise after you buy. You have more peace of mind with stocks like CBA than stocks like RSG. Or extending to this theory, you actually want a more stable and established company when you're investing in stocks. You may strike it rich if you identify a stable company that is rising in price for an extended time period. However, let me tell you, even though I found you CBA as an example, it is actually very rare, and the reason for this is because of falling interest rates experienced in the past 7 years. Furthermore, if you go back to my episode 1, and also episode 2 and episode 4, and also episode 6, I discussed the reason why CBA stocks and most bank stocks have been able to deliver record profit growth is because while interest rates were falling, the banks were able to fatten their profit margin by passing the full cut of interest rates on the savers whom they're actually borrowing money from, and then not cutting it fully on the borrowers, as in their customers who they receive interest payments from. In life, rewards often come with hard work and taking calculated risk and being lucky. This is no exception when it comes to investment. In fact, this is even more so. What I'm about to show you is going to prove this point. Now let's look at the figure. We're considering how investors of CBA and RSG stocks will perform over the same period if they invest $1,000 at the start of each month, come rain, hail or shine. So over this period, one would have invested $99,000. You can see that those who invested in RSG using this strategy would win out at the end by almost 20%. That's surprising, isn't it? They will accumulate $766,380 compared to those who invested in CBA stocks who would have seen their wealth increase to $646,028. Now both cases, investors would have received a whopping return on what was initially invested. We're talking about at least 6 times what they actually put in. However, we see that even though RSG stocks did not deliver higher returns over the entire period, CBA actually delivered higher returns plus dividends. Consistent investing actually resulted in more wealth accumulated. Now why is that? Remember that what matters is not the stock price difference. What matters is actually a relative price difference or the stock returns. Note that if you're making consistent investments, there are times when you're purchasing RSG stocks as they're falling and they actually hit rock bottom. The amount that you invested in those months bought you more shares of RSG. And these purchases, as the price recovered, would have delivered much higher returns to the end of the investment period. In some cases, a monthly contribution of $1,000 delivered $6,000 or more by the end of the investment period, and this applied for most of the 2015 and the early 2016 period. Now putting this into practice is very difficult, and some would say it will be quite insane in some cases. Our analysis has a benefit of hindsight in that RSG actually did recover and even did better after the gold bear market of 2013 to 2015. For a shareholder of this company, the psychological pain felt during the 2012 to 2015 period would have been not only excruciating, but some of the people who invested may well have been diagnosed with depression. I can empathize with those who say this because they cannot imagine investing almost $40,000 during this period on a company that is scraping the bottom without any evidence of sustainable recovery. Many would correctly throw in the towel, and they would have been rational to do so given the information that they know then. But I can tell you, I speak from experience. I went through this. I began buying RSG stocks in the middle of 2014, watched it go down, rode the bottom, doubled down, tripled down as the price declined further into 2015. And yes, I did reap the reward of the recovery. Even though I was lucky to miss the 2012 to early 2014 decline, I had actually done that watching the stock prices come down between 2012 to 2014. I did that with other gold mining stocks, not RSG. I had the insight into what was going on during that period because I was reading the right sources. And I was buying gold stocks, gold mining company stocks from 2013 up to this day. And some of these stocks, I have made multifold returns. And how did I maintain my discipline? It was I focused on the concept of stock returns and buying stocks as they fall rather than rising. But I also had the benefit of experts in this area. I also had benefits in understanding what was going on with the economy. And I'll explain some of these things in later episodes. So before concluding, I'll reiterate that these two companies I've selected are done so purposely to illustrate a point. Their price movements are not random, but are backed up by a combination of lower interest rate environment pushing asset prices up, strong industry performance, and good management quality for both companies, and to their credit. To identify such strengths require much time and knowledge of the broader economy, financial statement analysis, and knowing about the economic factors of a specific industry. These are not covered in this video, as you're aware, and we will investigate this at some level of detail in future episodes. Well, that's it from the Sydney Contrarian. Stay tuned for a future episode. Once again, God bless.